Chapter number 5, Fixed and Tangible Assets. In this chapter we will regard all the possible changes or movements regarding fixed assets. So we're going to start with the first concept, and that is the concept of an asset register. Now, for every vehicle or piece of equipment that the business owns, a separate page is drawn up in a file, which we call the asset register. Now, this page contains information regarding the specific asset, such as the date, when the asset was bought, depreciation, where the asset was bought from. It is therefore very easy to determine what the exact value of any specific asset is on any given date by just looking at the information in this file, or also called the asset register. Now let's look at an example together. Example number 1. Complete the page in the asset register for the following vehicle. A delivery van with the registration number QXV334GP was bought from Hatfield Motors on the 1st of November 2014 at a cost price of $600,000. Depreciation on vehicles is calculated at 10% on cost price. The financial year ends on the 28th of February every year, and the vehicle was then sold to P Joint for $340,000 on the 1st of December. So let's fill in the information we can and then calculate the rest. So this is known as a delivery van, therefore it goes into my general ledger account of vehicles. Registration number was given to us, date bought 1st of November, bought from Hatfield Motors. We bought it for a cost price of $600,000. So remember, cost price is the original price that we paid for the vehicle. Rate of depreciation 10% per annum on cost. Could have also said 10% per annum on the straight line method. Details if sold. We sold it on the 1st of December 2018. Sold it to P Joint. Selling price $340,000. Then they ask profit or loss on disposal. We don't know yet. We have to go and calculate it first. So what needs to happen every end of the year is we need to depreciate this vehicle against the 10% per annum cost price. So before we can do that, we need to first calculate or work out when did we buy it and how long we had it for each year. Because you see, if we bought it on the 1st of November, then that was in the year, which we only had it then for November, December, January and February. So for that first year, we only had it for 4 months of that year. In 2016, year ending 2016, we had it for the full year, 12 months. Year ending 2017, had it for a full year again. 2018 had it for a full year then. And then in our last year, because we sold it again in December, we had it only for March, April, May, June, July, August, September, October, and November. Remember, because we sold it on the 1st of December, we never had it for December, so we can't count December. It's the easiest to just take your fingers, literally count the months, and see how many months it is. Because if you count 1 month too little or 1 month too much, it makes this whole calculation wrong. So therefore we had it for a part of the first year, then for a full year, and then again a part of the last year. So in our asset register, this would have been calculated every end of the year. So this would have been up to date by the time we sell it. So our first year, $600,000 cost price times 10% depreciation rate times 4 over 12, because we only had for 4 of the 12 months. Therefore gives us $20,000. And because this is the first year of depreciation, that $20,000 would be the only amount in my accumulated depreciation account for this specific vehicle. Then for 2016, 17, and 18, we each had it for a full year, so my calculation stays the same. 600,000, 600,000, 600,000, because it's on cost price, so I use my cost price every time. times my depreciation rate of 10% times full year, to 12 months out of 12 months, 12 out of 12, 12 out of 12, leaves me with a depreciation every year of 60,000. Now let's see how we calculate accumulated from there. We always take accumulated of the previous year, add it with the new depreciation rate, and it's going to give me the accumulated depreciation for this year. We do the same. Accumulated depreciation of the previous years, now it's for the previous 2 years. Take that, add in the new depreciation, and it leaves us with accumulated of 140,000. Again, accumulated of the previous 3 years, added with the depreciation, and it leaves us with accumulated depreciation of 200,000. Now for that final year, be careful. My calculation now changes. It's still on cost, it's still 10%. But I never had it for a full year, I only had it for 9 of the 12 months. Therefore, I write there 9 over 12. That changes my depreciation for that final year to only be 45,000 Rand. So in other words, now if I want to add to the accumulator, I'm going to take the 200,000 plus the 45, leaves me with accumulated depreciation of 245,000 Rand. So the last thing for me to do is to determine whether I've made a profit or a loss on sale of asset. Now remember, this asset at the date that I've sold it is worth something to me in my books. And that it's worth to me is what I originally bought it for, minus all the value it's lost over the years I had it. So in other words, I need to go and determine my carrying value. And that carrying value is then compared against my selling price. So what we can do is we can draw up a little table like this and just say my cost price was 600,000. My total loss in value, accumulated depreciation, was 245. That leaves me with 355,000 carrying value. In other words, that's my book value. That's what it is worth to me in my books. I then went and I sold it for 340,000. Therefore, it was worth to me 355. I sold it for less. I sold it for 340,000. Therefore, I've made a 15,000 loss on sale of asset. So I'm going to fill in here profit or loss. No, I made a 15,000 loss. And we can just highlight that it was in fact a loss and not a profit.